In this module, we'll explore market volatility and the urge to take action. The recent worldwide market volatility and declining share prices have not only surprised some investors, but have also brought back some of the fear that was felt amid the market meltdown from June 2008 to March 2009, during which time the S&P/TSX Composite Index fell 50%. As a result, many investors feel compelled to take action. Driven by their fears, they want to do something. Under these circumstances, investors are prone to act on behavioral biases, focus on the short term, take their eyes off their longer term goals, and potentially make detrimental portfolio decisions as a result. There is no doubt that the ride has been bumpy recently. In 8 of the 14 trading days between August 19th and September 8th, the S&P/TSX Composite Index ended up the day by more than 1% or down by more than 1%, 3 of which were positive and 5 of which were negative. During 4 of the 14 days, the index was up or down by more than 2%. The result of that 3-week roller coaster ride was a 6% drop in the TSX Composite Index. While that may put butterflies in some investors' bellies, consider that 4 consecutive days of big losses between August 19th and 24th were followed by 4 consecutive positive gains. Those who sold after the 4 straight down days on August 24th missed out on these gains, which totaled more than 6%. What may follow in the weeks ahead remain to be seen, but the long-term trend provides some perspective. This most recent period of worldwide market volatility has been blamed on the reaction to China's deteriorating economy. Before that, the big worry was the situation in Greece. The next could be the pending interest rate hike by the US Federal Reserve, or some other global crisis. Some of these will bring swift and volatile market reactions, while others will fade into obscurity. But there will always be another crisis lurking on the horizon. Despite the market's recent behavior, we still see plenty of positives in the current environment. High-quality companies in the TSX Composite Index have reported the highest return on equity in the last 5 years. Furthermore, the current price-to-book ratio is now at the lowest point observed within the last 5 years. Earnings for Canadian stocks are at healthy levels with the prospect of stronger growth into 2016 and 2017, while the price of exposure is at periodic lows. U.S. inflation remains tame and the outlook for the U.S. housing market brightens. European economies are showing some positive signs as well. It's not possible to foresee every crisis or every developing bit of positive economic news, nor is it possible to predict how markets will react to these events. Investors do, however, have a level of control over their own investment destiny despite short-term market movements. By setting goals and properly aligning resources with those goals, market events become little more than noise. Goals-based investing helps investors build focused portfolios designed to pursue specific goals over predetermined time horizons. Aligning different goals with the resources available should reduce the level of concern associated with short-term market volatility. This is due to the fact that short or shorter-term goals, which call for the consumption of funds in the near future, will have a conservative bias built into the associated portfolio, theoretically resulting in reduced reaction to short-term market volatility. Funds earmarked for longer-term goals will be appropriately more risky. Given their longer-term horizon to meet the associated goals, short-term market volatility is less meaningful. Market volatility corrections in bear markets often make investors feel like they have to do something. While it can be unnerving to watch portfolio values decline, there is a strong argument to be made that market volatility alone is not a good reason to make changes in a properly constructed portfolio. If declining markets have worried you, instead of buying and selling investments in hopes of minimizing the damage to your portfolio, it might be time to take a serious look at your investment philosophy.